Welcome back to the $50 Dividend Investor Podcast, the show that proves you do not need to be wealthy to start building wealth. I am your host, Talon, author of the $50 Dividend Investor, available on Amazon. Each episode, we take one powerful concept from the world of dividend investing and break it down in plain, everyday language. No jargon, no fluff, just a clear and honest roadmap for the everyday investor. Let's get into it.
Welcome to the table where the green meets the gold. Green meets the gold.
A 9% dividend yield sounds incredible. It sounds like free money. It sounds like the kind of return that makes you wonder why everyone is not piling into that stock right now. And then, 3 months later, the company cuts the dividend in half, and suddenly that 9% yield is gone. The stock price drops another 20%, and the investor who chased that number is sitting on a loss, wondering what went wrong. This scenario plays out thousands of times every single year with new dividend investors, and it is almost entirely preventable. Today, we're going to make sure it never happens to you. Welcome to Episode 4 of the $50 Dividend Investor Podcast, where we are breaking down one of the most misunderstood and most important concepts in all of dividend investing, the difference between dividend yield and dividend growth, and why understanding both could be the single most valuable lesson you take from this entire series. Let's define our terms clearly before anything else, because these two concepts are easy to confuse and critically different in what they mean for your portfolio. Dividend yield is a snapshot. It is a single number calculated by dividing a company's annual dividend payment by its current share price. If a stock pays $2 per share annually and the share price is $40, the yield is 5%. That is it. It tells you what you are earning right now relative to what you paid. It does not tell you whether that payment is safe. It does not tell you whether it will grow. It does not tell you anything about the future. It only tells you about today. Dividend growth, on the other hand, is a story. It is the rate at which a company increases its dividend payment over time. A company that paid $1 per share 5 years ago and now pays $1.47 has grown its dividend at roughly 8% annually. That growth rate tells you something far more meaningful than yield alone. It tells you about the health of the business, the confidence of management, and the trajectory of your future income. Here is why this distinction matters so much in practice. When you invest in a dividend stock, you are not just buying today's income, you are buying a stream of future income, and the growth rate of that stream determines how wealthy you become over time far more than the starting yield does. Let me show you exactly what I mean with a simple comparison that I walk through in the $50 Dividend Investor. Imagine two stocks. Stock A has a yield of 7%, but its dividend has been flat for 5 years. No growth, no increase, just the same payment every quarter. Stock B has a yield of 3%, but has been growing its dividend at 8% every year for the past decade and shows every sign of continuing. On day one, stock A looks far more attractive. You are earning more than twice the income per dollar invested. But now let's look at what happens over time. In year one, stock A pays you $7 for every $100 invested. Stock B pays you $3. Stock A is winning. But by year 10, stock B's dividend, growing at 8% annually, has more than doubled. It is now paying you around $6.47 on that original $100 investment. Stock A is still paying $7, assuming no cut. But here's the real story. The share price of stock B has almost certainly grown alongside its dividend, meaning your original $100 investment is now worth significantly more. Stock A, with its flat dividend and stagnant business, has likely gone nowhere in price. And if anything goes wrong, an earnings miss, a debt problem, an economic downturn, stock A's inflated yield is the first thing on the chopping block. Stock B's management, on the other hand, has spent a decade demonstrating that growing the dividend is a priority. That track record is not just a number, it's a promise reinforced by years of action. This is the core philosophy behind the $50 Dividend Investor. We are not income chasers. We are income builders. There is a fundamental difference between those two approaches, and it changes every decision you make as an investor. An income chaser looks for the highest yield available today and reaches for it regardless of the risk. An income builder looks for the highest quality dividend growth available and holds it patiently while the compounding does its work. Income chasers often end up with damaged portfolios and dividend cuts. Income builders often end up financially independent. The choice between those two outcomes is made right here in how you think about yield versus growth.
Welcome to the table where the green meets the gold. Green meets the gold.
Now let's talk about the sweet spot, because this is not a conversation about avoiding yield entirely. Yield matters. Income matters. As a dividend investor, you want to be paid, and you want to be paid meaningfully. The question is how to find the balance between a yield that is attractive today and a growth rate that makes it extraordinary tomorrow. The framework I use in the $50 Dividend Investor targets stocks with a yield between 2.5% and 5%, combined with a dividend growth rate of at least 5% annually over the past 5 to 10 years. That combination gives you real income from day one, enough to reinvest meaningfully through your drip, while also giving you a growth engine that will increase your income every single year without you adding a single extra dollar. That is the sweet spot. Not the highest yield in the room, and not the fastest growing company in tech that pays a token dividend of 0.5%. Right in the middle, solid income today, meaningful growth tomorrow. Now I want to give you the red flags, the specific warning signs that a dividend cut may be coming before it actually happens. Because one of the most valuable skills a dividend investor can develop is learning to see trouble before it arrives. The first red flag is a payout ratio above 85%. As we discussed in episode 3, the payout ratio tells you what percentage of earnings are being used to pay the dividend. When that number climbs above 85%, the company has very little cushion left. One bad quarter, one unexpected expense, one dip in earnings, and the dividend is suddenly in danger. Companies with payout ratios above 100% are literally paying out more in dividends than they are earning, which is mathematically unsustainable. The second red flag is declining free cash flow. Earnings can be manipulated through accounting adjustments, but free cash flow, the actual cash a business generates after paying its operating expenses and capital costs, is much harder to fake. If a company's free cash flow has been declining for 2 or 3 consecutive quarters while the dividend stays the same, the math is moving in the wrong direction. Watch that trend carefully. The third red flag is rising debt combined with flat or falling revenue. A company that is taking on significant new debt while its revenue growth stalls is under financial pressure. That pressure eventually has to go somewhere, and dividends are often the first place management looks when they need to free up cash. The fourth red flag is something softer but equally important: changes in management language. When you read a company's quarterly earnings call transcript or watch an investor presentation, and the executives start using phrases like reassessing our capital allocation priorities or evaluating the sustainability of our current dividend policy, pay close attention. That kind of corporate language almost always precedes a cut. Companies do not announce a dividend reduction out of nowhere. They telegraph it in cautious language weeks or months before the actual announcement. Learning to read that language is a skill that will protect your portfolio more times than you might expect. I cover this in depth in the $50 Dividend Investor, including specific examples of the language patterns that have historically preceded major dividend cuts in well-known companies. So here's where we land today. Yield tells you what you are earning right now. Growth tells you where your income is going over the next 10, 20, and 30 years. The sweet spot lives between 2.5% and 5% yield with at least 5% annual growth. And the red flags, high payout ratio, declining free cash flow, rising debt, and cautious management language, are your early warning system for protecting what you have built. Put these tools together, and you have a framework that makes you a genuinely sophisticated dividend investor, regardless of how long you've been at it or how much money you're starting with. That is the entire point of this podcast and the book it's built on. Everything covered today is laid out in greater detail in The $50 Dividend Investor by Talon, available on Amazon, link always in the description. Next week, we are moving into one of the most practical and most shareable episodes of this entire series, how to build your very first dividend portfolio on a $50 a month budget, step by step, from your first stock purchase all the way through your first full year. You are not going to want to miss it. Subscribe now so it lands right in your feed the moment it drops. Start small, think long, build forever. And that is episode 4 of the $50 Dividend Investor Podcast. Yield is a snapshot. Growth is the story. And the story is what makes you wealthy over time. Remember the sweet spot: 2.5% to 5% yield, at least 5% annual growth, and always check the red flags before you commit a single dollar. That framework alone puts you ahead of the majority of new investors who never think beyond the headline yield number. If you're ready to go deeper, the $50 Dividend Investor by K.R. Talon is on Amazon. Link in the description. It covers yield, growth, portfolio building, and dividend cut protection in far greater detail than any single episode can. And if this episode helped shift how you think about dividend investing, share it with someone who needs to hear it. One conversation about dividend traps could save a fellow investor a very expensive mistake. Next week, we are getting completely practical. How to build your very first dividend portfolio on a $50 a month budget, step by step, from your first stock purchase all the way through your first
Welcome
full
to
year.
the table
You're not
where
going to
the
want to miss
green
it.
meets the
Subscribe
gold.
now so it lands right in your feed the moment it drops. Start small, think long, build forever.
I'm K.R. Talon, and we're planting seeds today, not just checking the ticker.